Hello everyone, it's time for this week's market analysis. On this channel, we break down trading strategies and insights in a way that's easy to understand, all through chart analysis based on Dow theory. If you want to dive deeper into the methods we use, there's a link to an explanatory video in the description. Be sure to check it out. Let's get as good at technical analysis as a raccoon is at using its paws, crafty and quick. If you found this video helpful, please give it a thumbs up and subscribe to the channel. Now let's jump into this week's market. Let's take a look at the USDJPY chart. We'll start by analyzing this week's price action. This is the weekly chart. This week formed a bearish candle with a long upper wick. Although the previous 3 weeks were bullish, the candlestick bodies were relatively small. This week's bearish candle, with its long upper wick, may mark the beginning of a downward move. So we'll be watching closely to see if this becomes a turning point. Now let's move on to the 1-hour chart. The yellow vertical line marks the beginning of this week. The market opened with a gap up and continued to rise without filling that gap. In last week's video, I talked about the potential for the rally to stall, and indeed, the price stopped at the uppermost green line, a level we had identified as a resistance area formed by a previous inverse head and shoulders pattern. I mentioned that if you had a long position around this area, it would be wise to watch the price action here and consider taking some profit. After hitting this resistance zone, the market formed a head and shoulders pattern on the 15-minute chart and started to drop. This was a great entry point for a short position targeting the larger downtrend on the daily chart. Placing your stop loss here would have offered a favorable risk-to-reward ratio. This drop is the same move we saw forming the upper wick on the weekly candle. Price fell to the 4-hour chart's most recent higher low, but bounced without breaking it. So according to Dow theory, the 4-hour chart is still in an uptrend. However, since the daily chart is in a downtrend, I decided not to take a long position off that 4-hour support. Of course, there's still a possibility that the price could continue rising, but as it approaches the daily swing low, selling pressure is likely to increase. From a risk-reward perspective, earlier buy entries offered better value. This is because the price is now far from the average price, and the market tends to revert to that mean, a principle known as Granville's Law. Next week, the key will be whether the daily downtrend resumes. Now let's go back to the weekly chart to analyze the current market conditions in more detail. On the weekly chart, this purple line marks the most recent higher low. Price bounced before breaking below this level. Since the candle body hasn't closed below the line, we can say the weekly chart remains in an uptrend from a Dow theory perspective. However, the retracement has been deep, and the price failed to make a new high, indicating increasing selling pressure. In other words, the weekly chart lacks clear direction. Although we saw a bounce off the weekly resistance line, the long upper wick this week could mark the beginning of a potential downturn. Going forward, there are 2 scenarios, either a 3-wave correction downwards or a continuation of the uptrend. If we confirm a 3-wave drop, the next support level to watch will be here. This level aligns with the target of a downward N wave and has previously acted as a strong support zone. Let's move on to the daily chart. Currently, the price structure remains in a downtrend. This level is the most recent lower high, and price has yet to break above it. So we still consider the daily chart to be in a downtrend. This recent bullish candle was completely negated by the following 3 bearish candles, suggesting that selling pressure is still dominant. Now for the 4-hour chart, this is the current wave structure. The most recent higher low on the 4-hour chart is here. As we discussed earlier, price dropped but didn't break below this level, so technically, the 4-hour uptrend is still intact. That said, with the daily chart in a downtrend and the 4-hour pullback being quite deep, it's entirely possible that even if price bounces, we could see another drop forming this type of wave. Whether or not price breaks this high will be an important factor. Although we're still in a 4-hour uptrend, it's wise to maintain a bearish perspective. Also, the 4-hour ascending channel has been drawn using these 3 points. It serves as a guide to monitor ongoing bullish momentum. Currently, the price is near the lower boundary of that channel. If price breaks both the channel and the 4-hour high or low, both the daily and 4-hour charts would then turn bearish, increasing the likelihood of a move back toward the weekly resistance line. Next, let's take a look at the 1-hour chart. And this is the current structure. The most recent lower high is here, so the downtrend is still intact. Although price has broken the descending trend line, it hasn't broken above the lower high, so it's difficult to justify a long entry from a higher time frame perspective. If you're considering buying, you'd ideally want to see a full bullish reversal on the 1-hour chart, followed by a pullback and confirmation of a bullish structure on the 5 or 15-minute chart. Also, this pullback is shallow, so some traders might already consider this to be the 1-hour swing high. In that case, for the 1-hour trend to turn bullish, price would need to make a much larger move upward, which would make it even harder to consider buying. To summarize the current trend across time frames: weekly unclear direction, daily downtrend, 4-hour uptrend but possibly reversing, 1-hour downtrend. Let's now go over the potential scenarios going forward. Bearish scenario: if price rises from the current level next week, pay attention to whether it can break above this resistance. You could use Fibonacci retracement to estimate possible reversal levels, assuming this move was the end of a downward wave. However, it's better to base trades on clearly visible resistance zones on the chart. For example, this level may be seen as the 1-hour swing high by some traders. It also overlaps with the neckline of the 15-minute head and shoulders pattern. For short entries, always look for confirmation of trend reversals on the lower time frames. If price drops next week and breaks the 4-hour high or low, both the daily and 4-hour charts would turn bearish, making it much easier to sell. Wait for a pullback before entering a short. Bullish scenario: if you're looking to go long from the current 4-hour support, the risk-to-reward ratio is good. However, given the strength of the previous sell-off, it may be too risky. It's safer to wait until the 1-hour chart fully transitions to an uptrend. If that doesn't happen, wait for the price to reach the weekly support line and then reassess potential long entries. Did you find that helpful? If you did, please give this video a thumbs up and subscribe to the channel. Next week, let's be as skillful with technical analysis as a raccoon is with its paws, and trade with the same caution a raccoon shows in the wild. I wish you all successful trades. Best of luck.